Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And I took a look at my audience on the YouTube chat before I launched things, and I can see there are hundreds of people here. I know a lot of you are going to be new to this series, so I thought I'm going to peel this back. Let's go through a beginner's guide to trading covered calls for income. So I think this is going to be an interesting discussion. We have actually an example trade in our paper money portfolio right now that might highlight how income can get overlooked as a variable in a self-directed investor's performance, especially, when the markets are just screaming higher. So we got a lot to cover today. We're going to be talking about what a covered call is. We're going to be setting it alongside a current example. We're going to be planning and placing an example trade before we're done. So before we dive into any of that, let me first of all say hello to everybody who is joining us there in the YouTube live audience. Great to see so many familiar names. Great to see so many who are here for the first time. But hello there, Paul, Yael, Nick, E. Dunny, Skywise, JDLMI, Noodlebrains, Victor, Eva, Lawrence, Elaine, Mark, Tim, everybody else. Thanks for joining us week after week. We definitely appreciate your attendance and your contributions to these discussions. If you are among those that are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy that recording. That's a great way to watch these webcasts, but be aware that you are invited to join us in the live stream. If you'd like to be here, this is a Monday webcast series. We kick things off every Monday at 2 Eastern time. We run about 40 to 45 minutes each time. So we'd love to have you here. I also want to let everybody know that's here in my live audience and my very good friend Barb Armstrong is going to be hanging out in the chats with those here in the live stream attendance. She's going to be keeping an eye on any questions that come in, and if I can't get to those, she's going to help me pick up the slack there. So thanks for having my back there, Barb. Barb and I have worked together for years and years and years, and so she brings a ton of experience to this discussion. Barb and I would also like to issue an invitation to everybody listening to please follow your favorite Schwab presenters on social media. You can find Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find her. You can find me on X at Cameron May CS. You can also find us both on LinkedIn now. So Barb, you can chat in your LinkedIn profile. Mine is you just go to linkedin.com/in and then /Cameron May CS. My guess is, although I haven't confirmed this yet because we're very new to LinkedIn, that Barb's would be that linkedin.com/in/ Barb Armstrong CS, but double check that link. Anyway, thank you, Barb. You can correct me if I got that wrong, but let's get into this discussion. We're going to be talking about covered calls today. I'm going to be going at a level that hopefully everyone can follow. I am going to be illustrating these concepts on what's known as the Thinkorswim desktop trading platform. So I'll show you how to access that if you haven't done that before. But of course, with all of this, there is risk. So we need to bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay. So I'm going to set out an agenda here for today's discussion, but as I do me this favor. Let me do a quick refresh over there on YouTube. So I think we have over 300, now almost 500 people watching the live stream. So just give me a quick yes or a no, a Y or an N. Are you familiar with the concept of covered calls or not? I would suspect with an audience as large as the live audience that I have today, there are going to be maybe hundreds who are just brand new to this concept. So I want to go at the pace that everybody can follow, but don't worry. By the time we're done, we're going to be planning and placing an example trade. So here's what we're going to be doing today. We're going to be talking through just exactly what a covered call contract is. We're going to talk about what it means for our would-be income investor, how it might make money, how it might lose money. And then we're going to be planning and placing an example trade on what's known as the Thinkorswim desktop paper money platform. All right, so I see a lot of yeses. There are plenty of nos. Great to have that balanced audience because I might need to lean on those that are a little bit more veteran with a strategy to help fill in the gaps for those that are new. All right, so let's get into this discussion. However, let me show you. We're going to be looking at something that's called Thinkorswim desktop. This is a paper money. It's like a practice trading environment. You'll notice up here in the upper left, it says simulated trading, but it's called Thinkorswim. And if you haven't used it before, let me show you where you can download it for free. All right. So you can actually go to your online account with Schwab, just log in at schwab.com. And if you go to the trade tab right here at the top, you'll see Thinkorswim right there in the drop-down menu. So you just click on Thinkorswim desktop. And then the one other key step is to scroll down just a little bit. And then there's a big blue button right here that says learn how to enable Thinkorswim. If you click that and you read the on-screen prompts, it'll just walk you right through how to download this software. It'll load it onto your computer, and it'll create an icon on your computer's desktop. Looks like this. Or if you want to launch Thinkorswim through your computer start menu, it'll be there as well. But when you first go to launch Thinkorswim, it'll ask you for a username and a password. Don't let the panic set in. There's no special username or password required here. You just use your Schwab credentials. So as you log in, you'll be prompted, are you looking for live trading or paper money? So I've just selected paper money, logged in, and that's where we find ourselves now. So we're on the simulated investing and trading software known as Thinkorswim. And within this, now for my regular attendees of this series, they know that we have a whole portfolio of example covered calls and what are known as short puts. And I just wanted to focus on one of those today. So I've created a little group here on Thinkorswim that I'm just calling example covered call. And we're going to look at our ABBV, our ABV position, where we own 200 shares of stock. And it looks like this is not going so well. We purchased these shares a couple of months ago for $227 and change. And right now they're at $221 and change. And so it looks like we're losing money, down about $1,000. I'm going to make the case right now that this is actually essentially a break-even investment at this moment. Here's why. So let me go to a chart. This is the history of our ABV investment. We bought 200 shares right here on December 15th for $227.18. Now, as the owner of shares of stock, of course, if there's a dividend paid, if we own the shares before the ex-dividend date, then we're qualified to receive those shares. So let's just say that we received, or not those shares, but that dividend, that's lowered our, let's say our break-even point on this investment a bit, from $227.18 down to $1.73. So we're more down around $225.50. But there's even more to the story. If you follow this webcast series over time, we've actually been collecting additional income along the way in those 2 months that have already transpired. So I want to bring up the rest of the history here. I've actually made some drawings. Let's just add those. These are our ABV covered call drawings. So here we initiated the stock position. We've collected a dividend, but we've also entered into 2 different contracts. We originally sold what's known as a $240 call for the 16th of January, for which we closed out a $1.93 per share profit. Now, after that, so we went this span of time with that position, then we went this span of time with a different position. We sold 2 January 30th calls, and those expired for an additional, it's hard to see, but $1.83 in realized paper money. This is just practice trading. But the aggregate effect of those, if we add up $1.93, $1.83 plus $1.73, that just works out nice. And I didn't intend for that to be quite that proportion, that nice. But overall, it has lowered the break-even point of this overall position to $221.69. So instead of just being a shareholder who might be looking at a break-even, stock was here when we bought the shares and they've dropped down to here, instead of being down about $6 because of that income that's been collected, we're only pennies away from break-even. And this is just an example of the potential impact of a covered call. Now, there are definitely potential drawbacks to it as well. So we need to talk about the pros and the cons of this income-oriented strategy. But I do want to introduce those that are not familiar with covered calls to the concept of covered calls. Now, one thing I do want to discuss before moving on with the rest of the presentation is that if you want to see the trades as we're placing them, these were captured in previous webcasts that have now been added to the archives known as playlists on our YouTube channel. So do yourself a favor right now. Again, I'm looking at over 600 people watching live. What are we at, like 628 now? If you're new and you haven't subscribed to our Trader Talks channel yet, just pop down below the video, click on the subscribe button. That only takes a second. It doesn't cost anything. But if I go over here to our YouTube channel, let's pop over here. Our YouTube channel's full name is Trader Talks Schwab Coaching Webcasts, and we're doing new live webcasts every trading day. As long as the markets are open, we're here doing 6 or 7 or 8 new webcasts on a range of topics, including this one Monday webcast series. I do it every Monday, and we record those Monday webcasts and we post them here on our channel. So you can join the live streams on the channel, pick a topic, watch the live stream, but you can also find our playlist for concluded webcasts. So if I go to playlists, I can scroll down, you'll see how many different series we have or have had, and they're all captured here, not all of them, the vast majority. But in any case, if I go down a little bit down toward the bottom, we're going to run into my face right down here, and there's covered calls and short puts, and I can see the full playlist by clicking right there. So that's how to find it, and you can watch these previous webcasts if you want to see the logic of the previous trades, see when we got into them, how we managed those as we went forward. What I'll also do, as you're subscribing there, let me just put that link to my playlist here. For those that are here in the live stream audience, I'm going to paste a link into the chat right now. There you go. That'll just take you right to this page where I am. You can just use that link after the webcast is over. Just know, you can also just, if you're watching on the archive, if you're watching after this live stream is included, you can still just use the steps that I showed to find the playlist. Okay, but let's get back to covered calls. What in the world are covered calls? Well, here we find ourselves. Let's just put ourselves back in the shoes of an investor in shares of stock. Here we have 200 shares of stock. Well, the investor's hope, typically, just like it was for us, we saw this stock had been going up and up and up and up, and right here at the moment that we bought, it looked like it was coming up this ascending ramp of prices, and maybe it was set to go higher. So the investor's hope always is to buy low, so hopefully they can sell higher later. Well, that's called price appreciation. That's one potential way to make money from stocks. However, now as owners of shares of stock, there's a second potential way that we might make money. Yes, if it happens to pay a dividend, there's that as well. I actually teach a webcast series. It's called Investing in Dividend Stocks, if you want to check that one out. That one's on Thursdays. But for those that understand options trading, there may be another way to pursue income or to pursue growth even from share ownership. So here's the concept here. When we own shares of stock, do you think that there might be somebody else out there that could potentially be interested in buying shares of the same stock? Of course. Almost certainly there's somebody out there right now shopping around considering buying shares of AbbVie. Well, what we might do is enter into a contract where we agree for a period of time, a defined period of time, to allow someone else to buy our shares from us. Now, we're not going to do that out of the kindness of our hearts. We're going to require a payment. It's a per share payment. But if we accept that payment, and that can become an income for the portfolio, in exchange for that payment for a period of time, we say, okay, other party, you have the right to buy my shares from me for a fixed price. We just agree on a price, and that's the contract. So that's known as a covered call. So now I'm going to pause the discussion of that covered call contract for just a second, because I just caught out of the corner of my eye, there's a link that's been added to the chat window, and this is important. They're doing a survey right now. I don't always get surveys. They happen every once in a while. Coaches are not in control of when these happen. But when there's a survey link that's dropped into the chat window, which there has been right now, if you do me this favor, click on that survey link. It's a really short survey, literally 2 questions, and then a comments box and a suggestion box. I'll just tell you, if you take the time to fill out that survey, it's not a wasted effort. They send that stuff right to me, and I read through the data, I read through the comments, I read through the suggestions. Sometimes I build my webcasts around those things, so it always helps. So thanks for filling out that survey for me. But back to our discussion of a covered call. What I want to do right now is enter into one of these contracts. And this is kind of the scary part, first time you ever do it. What I want to say, though, is as we're doing this, up here in the upper left, this is very reassuring. It says simulated trading. That's right. There's no risk in this example practice trade that we're about to place. But here's the way it works. So as a reminder, if I go to the Monitor tab, this is where I monitor my current positions. I can see there are the 200 shares of AbbVie that we purchased. And I can even see here's my trade price of $227 if I need that as a reminder. But let's suppose, as we go to our charts, let's suppose that our owner of AbbVie is looking at the price right now is at $221. And they're looking out, let's say, to March 20th. There is a very specific reason I'm looking at March 20th. Options traders automatically know. There are lots of different contracts we can get into of different time frames, but the most heavily traded ones tend to be the ones that go through the third Friday of each month. They're the ones that have been around the markets the longest. Anyway, so this is the March third Friday contract time frame, March 20th. Let's say that our owner of shares here is considering entering into one of these covered call contracts, maybe that extends out through March 20th, and they think to themselves, you know what, as I look at this stock, there's only been one day where we even touched above $240. So in my view, somebody's asking a really good question. Chuck says, how do you know if it's a good time to put on that? A good time? It's always in the eye of the beholder, but usually the real answer comes after the fact. We can look back and say, oh, that really wasn't a good time. Or, oh, it really was a good time, the time that I chose. So far, so good. We have two where it was probably a good time. I don't know. We'll see how this one works out. But let's just say that our shareholder is looking back over the 12-month history of AbbVie and stretching beyond that, and they think to themselves, you know what? This stock, let me draw in a line up here at $240. Matter of fact, let's do it this way. I'm going to switch up my drawing tool. Let's just make a horizontal line using our price level tool right at $240, right there. And the nice thing about this is I can pin it right about $240, right click on it, and extend it to the left. Anyway, so you can just see how many times has AbbVie's price been above $240 the last 12 months? It's been up there for maybe a handful of hours, period. So let's say that our investor now thinks, you know what? Even if this thing gets a good head of steam, it seems like it's unlikely to go above 240 by March 20th. So how about I get into one of these contracts that Cameron's talking about, where I agree that someone else, if they want to, they can buy my shares for $240. I'm not going to sell it to them for a penny less, though. That's going to be our example trade today. So here's what we're going to do. We're going to go to the trade tab. And when we first visit the trade tab, if we type in our symbol here, we'll see something down below known as the option chain. It's kind of like an advertising bulletin board for options contracts of different lengths. So there are some contracts that only go for 4 days. They expire on the 13th of February. Right now is the 9th of February. Or we have some contracts that might go out to the 21st of January of 2028. These are 711-day contracts. What you'll notice for each one, though, it has the number 100 next to it. What that means is that we are about to enter into a contract where we may exchange 100 shares of stock. That's what the 100 means. Ray says, what's the difference between open and close? That's a reference to whether we're starting or ending a trade. That's about it, Ray. Whether we're talking about a stock or an option, opening a position, closing a position. There we go. Now, if you're talking about open and close on a stock chart, that's just opening bell at 9:30 Eastern with stock trading. Ding, 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 they ring the bell. Or 4 o'clock Eastern, closing bell. That's the normal hours of trading for stocks. All right. Anyway, so how about for this example, let's say that our shareholder doesn't want to be in a contract for the next 2 years. Maybe they're just looking at a contract for the 20th of March. That's a 39-day contract for the potential exchange of 100 shares of stock. We actually have two. So we're going to be doing 200 contracts. Exactly right, Sherry. 2 contracts is 200 shares. Yep. So that's how many contracts we are going to, get this weird phrasing, sell into. All right. So I'm going to come here, and you notice a little caret next to the 20th of March. If I click on that little arrow, it actually exposes now all kinds of different contracts. that we might get into. So let's focus first on this word strike. You'll notice that their number is 180, 185, 190, 195, 200, and so on. These are prices, these are stock prices at which we can strike a deal with another investor to maybe sell our shares to them. So as an example, let's go to 240. If I were to enter into a contract here, I'm agreeing to sell my shares to someone else for $240. That's the deal. Now, as I look over here to the left, we'll see two other important columns. The 20th of March, 2026, we already know what that means. But bid and ask are defining how much these contracts are trading for at the moment. So here, let's spell this one out. Chuck's asking a good question. So many good questions. You know, you put 700 people in an audience and they can ask a lot of good questions. I apologize, I can't answer all of them. So with my apologies, I do have to operate within the strictures of a 45-minute time frame. So I'll answer as many questions as I can, but make sure that we stay on track, keep the logic of the discussion moving, flowing forward. But here's our example trade. Not our example trade, but our example trade. We are going to do a covered call. And it begins with share ownership. In this case, we own 200 shares, but let's just talk about 100 shares for a moment. We can double it. That's an easy logical jump. But typically, with the vast majority of covered calls, for one contract, it's 100 shares. There can be some oddball exceptions, and when you see those, it'll have a different number right here. But these are what are called standard contracts. But right now, there are 100 shares that are right now trading. I'm just going to jot this down. 221.7. Actually, look at this. We are above break even for our overall journey on these trades right now. So even though price is down, income has helped to offset that. It's gotten us back above break even. Anyway, 100 shares. Right now, they're worth $221.78. All right. But when we own shares of stock, we might be able to get into one of these covered call contracts. So the second part of the trade is to enter into that contract. And the way that we enter into it is we sell a contract. So let's look at this 240 contract. Right now, priced somewhere between $1.57 and $1.72. When you're trading calls, well, when you're trading options or stocks, you'll frequently see these two words, bid and ask. I don't mind explaining what those mean for just a moment. So when we're buying a stock or buying an option, we typically pay at or close to the ask price. It's kind of like if you wanted to buy a house, you go knock on the guy's door and you say, hey, homeowner, or the woman's door, how much you asking for your house? And they say $500,000. And okay, you pay the ask price. On the other hand, if we want to sell something, we offer it up for bids and we sell to the highest bidder. So buyers typically pay at or around the ask price. Sellers typically receive at or around the bid price. And there tends to be a little bit of a distinction between the difference between the two. Sometimes we can get our orders filled in the middle. So in this case, that might be somewhere between 157 and 172. How about we just call it 165? So we're going to sell, in our example trade, the 20th of March, $240 call. And I just kind of threw out an example price there of $1.65. So these two positions complete what's known as a covered call. So let's talk about that terminology for a moment. Why is it called a covered call? Well, back in the old days, we did this over the phone. And you can imagine if we own 100 shares of AbbVie, they're currently traded for $221, but we enter into a contract with somebody else where they have the right to buy those shares from us for $240. Let's say we get somewhere closer to the 20th of March and the other trader says, you know what? Maybe I want Cameron's shares. So they give us a phone call and they say, Cameron, my contract says I can buy your shares for $240 and I want those shares right now. And I might say, that's okay. I got you covered. I got the shares right here. It's covered because I own the shares. And the call, I just think of it as like in the old days, it was a phone call. It's not exactly why it's called that, but to me, that's a serviceable way to understand the sort of logic of the contract. Does that help? I hope that does. But that's the whole deal. That's our covered call. we own some shares of stock and we agree to sell them to someone else. And in exchange, that someone else is paying us on a per share basis. So let's do some additional math here. If we're getting paid $1.65 per share, and each contract is for the potential exchange of 100 shares of stock, how much is actually being credited to our portfolio as an incentive to get into this deal? Well, if we had 100 shares, that would be $165. We have 200 shares, so that's $230 that are being paid to our portfolio. That's being paid to our portfolio. And you think, oh, good. Does anybody else's dad do this? My dad, all of his life, when he get excited about something, he'd rub his hands together like that. Now, before we get too excited, though, we have to realize nobody's just giving us $230 out of the kindness of their hearts. There's a trade-off here. For the next 39 days, or through the 20th of March, entirely out of our control, someone else has the right to snatch up our shares for $240 per share. That's a deal. If they decide, hey, Cameron, I want to buy your shares, and they exercise their right, they assign that contract. Sorry, that's out of our control at that point. The shares are sold at $240. That's the way it goes. I'll thank you for somebody correcting me. It's $330, right? I did my math wrong. Sorry, I blew it. Sometimes I just let my mouth run and I assume that my math is correct. I usually get it right. Give me some credit here, right? My veteran attendees, I'm usually pretty good at math. In that case, it sounds like I blew it. $330, obviously. Yeah, thanks for the correction. If you ever see me making a mistake, let me know about it so I can get correct information out to my audience. But in particular, if I write it down, because that's just not good. I don't like to write things down. It's one thing to verbally just mess up, but another thing to write it down and then really imprint it on people's brains. Anyway, that is our covered call deal. So let's put that on our chart so it can help us visualize things. I'm gonna change this up here. Let's just remove this previous drawing, and I'm just gonna draw in a new one. Let's put it right up above today's price, so that kind of gives us a benchmark for where we're starting this trade. And let's run it right on out to the 20th of March. So that kind of puts a visual ceiling, which is actually what we're doing in this contract. Because let's talk about what might happen from here. Oh, Vivian says, how much did I pay? So right here, Vivian, I paid $227.18. Now, along the way, I've collected a dividend. Along the way, I've also realized a profit of $1.83 on one call contract, $1.93 on another, I should say, pair of contracts. So that'd be $193 times 2, $183 times 2, $173 premium times 200. Yep. But if we decide to get into this deal, we need to go in with our eyes wide open, because it's fun to focus on the fun part, which is getting some income, but we also know we need to know the trade-off. So let's talk through what can happen between now and the 20th of March. Let's say this stock really starts to blast off, and despite what we thought, let's say it goes above $240. Maybe it's up here at $245 come March 20th. What happens at that point if they haven't done it already? Because they could. Shares are worth $245. Someone has the right to buy our shares from us for $240. They're getting a discount at that point. You think they're going to buy those shares? Yes, they're going to buy those shares, with very rare exceptions. They buy the shares, they pay us our $240, but we also keep the $1.65. So we net out of this $241.65. That would be it. But we're done. We don't own the shares anymore. That's kind of like it's over, right? So this is what's known as being called out. Sometimes you hear that as it's like a negative thing. I don't know, you do the math with me. If we sell our shares for $240 that were previously purchased for $227.18, we've already collected a dividend, we've already made $1.83, we already made $1.93, plus we got another $1.65, and then we sold the shares for $240. Now we might feel a little bit bad that we're underselling the current price of the stock a bit, but overall, that would be quite a profitable outcome. Now, that's one thing that could happen. Well, what if the stock goes up, but it doesn't go above 240? So come, let's say March 20th, this other party here who has the right to buy shares from us for 240, they're out of time. They need to make up their mind. Are you going to buy the shares from Cameron or not? And the answer is almost certainly no. They're going to say, Cameron, your shares are only worth 230. I'm not paying you 240 for them. So they walk. Now, as they walk, they leave behind their $1.65. We keep that $1.65. We keep the ownership of shares. And maybe we repeat this process, sell another cover call. CT Whaley just asked an excellent question. How is the $1.65 taxed? Here you go, CT Whaley. I can't tell you. I'm sorry, I'm not a tax advisor. It's not my role. What you need to do is talk to a licensed tax professional. Do I know the answer? Of course I know the answer. Well, it's also going to depend on one's personal tax scenario, of course. But yeah, you need to talk to a tax professional. It's outside of my role to talk about taxes. All right. Anyway, I hope you'll forgive me for that. I hope that just understanding the strategy is sufficient to justify your time with me today. So, in this case, the contract would almost certainly not be assigned. Here's the funny thing. Could it be assigned? Yes, it could. It probably won't. But every once in a while, somebody gets a wild hair and says, you know what? I'm going to do the mathematically irrational thing, and I'm going to overpay Cameron for his shares by $10. And so they assign the contract, and they overpay to buy the shares. Okay, that could happen. Just don't think it's going to happen, because it probably won't. Now, what else could happen? Price could go down. This is where the pain really starts to creep in. This is not what we want, whether we have a covered call or we just own shares of stock we never did the covered call. Let's say the stock relatively collapses down to $200. So let's get fairly extreme here. Someone has the right to buy our shares from us for $240. They're only worth $200. Are they going to buy the shares? Nope. They're going to say, Cameron, keep those lousy shares of stock. I don't want to overpay by $40. And you can keep my $1.65. So the $1.65 becomes a little bit of a tiny little consolation price. But it only serves to take out some of the sting of loss, because these shares were worth on day one $221, and now they've fallen to $200. And I think you can see that's a $21 unrealized loss on the stock. And the $1.65 is only minor consolation. Although I will say, it still probably feels just a little bit better than just having purchased the shares and watched them drop to drop $21 without any income. But those, if we allow this to go to expiration, those are our three potential outcomes. So what anybody needs to do who's considering something like this is to give real credence to each of those possible outcomes, and we have to be okay with it. So we need to recognize share ownership is a risk, and if prices fall on the shares, loss comes with that territory. We also have a cap on how much profit we can make. The trade-off is we're collecting some income for that. So that is known as a covered call. Now, I'm going to go ahead and place the trade. Let's go to our trade tab. We own the 200 shares. So what we need to do to make this a covered call is just make sure that we sell the contracts in the same account where the shares are held. We don't even have to call it a covered call. We just go to the trade tab, go to the 20th of March, go to the 240 strike, and just click on the bid price. Remember, sellers sell to the highest bidder. So as I click on the bid price, that's going to bring up an order to sell 10 contracts. Do we have 1,000 shares? No, we have 200 shares. So let's change that to -2. Shahad Amir says, oh, you're talking to Mark. Okay, never mind. I don't attempt to ask questions that weren't, or answer questions that weren't asked of me. Anyway, so let's just sell 2 of these contracts. It looks like they're now trading a little bit less than $1.65, somewhere between $1.58 and $1.64. Let's see if we can get $1.60 for these. So I'm going to click the little plus sign. It takes us up to $1.60, locks that in as what we call a limit price. That just means I'll sell this, but I need to get at least $1.60. That's my limit, the least I'll accept. It's just an example in this case. Another trader might say $1.64. Someone else who's willing to stick around, see if they can try to get a little bit more money, Might say $6.65 or whatever, but I'm just going to put in $1.60 and let's click confirm and send. So I'm doing this in the same account where the shares are held. Notice nowhere on the order does it say covered call. I'm just selling a call in an account where the shares are already held. I'm going to click confirm and send. So we're selling these two AbbVie 20th of March 240 calls, trying to get $1.60 for those. If we get those, that's a $320 credit. We have to subtract out commissions, so that would actually leave us with $318.70. We might get more than $1.60. Now, it's not going to be less. It just won't fill if we can't get $1.60. So let's send this order off. Now, notice right here it says, Cameron, your maximum loss is infinite, which would be true if I didn't own the shares that I am obligated to give to somebody else. But I do own the shares, so that's not true. Let's send this order off. And we've just sold into our very first covered call. We did get $1.65. Look at that. Math is going to line up very nicely. I don't even have to change my math over here. $1.65 is exactly what we collected. So we have a few minutes left. So we've talked through what could possibly happen with this trade from here forward. I don't want to leave us with the impression, though, that we're stuck in this trade. Let's suppose that the stock starts, let's get rid of this one scenario here. Let's look at these two. Let's say we sell this call. We think, okay, good. Now I can just watch my stock climb, and as long as it's not above 240, then I'm probably not going to have to sell my shares and everything's good. And then the shares start to drop and we start to sweat because we're the shareholders. And that $1.65 isn't feeling like much income as the stock is falling further and further and further. And we might be thinking, man, I wish I didn't have this stupid contract because I want to sell my shares, but I'm already contractually obligated to sell to someone else. Can't sell shares that I'm already obligated to sell. Well, at that point, what we might choose to do is buy out of the contract. Hey, you veterans, what happens when stock price falls to the cost to buy out of this contract? We got paid $1.65 to get in. As the stock price falls, calls become less valuable and it costs less. So maybe we have to pay $1, maybe we have to pay 50 cents. But to close out of that contract, so we're no longer under that obligation, then we can sell the shares. Now, I have to say, not every stock has very liquid options, and it can be relatively hard to get into or out of the contracts on certain stocks. And even on really liquid stocks, it can still be comparatively difficult to get into or out of. So one thing that's a point of emphasis with a lot of covered call traders is that they're doing this on stocks that are heavily traded. Because if the stocks are heavily traded, the options are very likely pretty liquid, and maybe they can get into or out of the positions fairly smoothly. But it's never a guarantee. Anyway, but just know that because we entered into a contract that says the 20th of March on it, doesn't mean we have to be in it until the 20th of March. Now, on the other hand, if the stock starts to rally, and initially we were feeling pretty good that we might not have to sell the shares for 240, and we really want to keep the shares, we might choose to buy out of the contract again. But as stock prices go up, it can get more expensive to buy out of these calls. And so we might have to pay more than $1.65, take some lumps on the contract, but that allows us to keep the stock. Are we notified of exercise expiration? How does this show up in our... That's a good question, Elizabeth. And I do have a couple of minutes to address that. With my apologies, probably not going to get to every other question. That's probably going to be the end of it. But yeah, what if we get to March 20th, or let's say so March 20th is a Friday. Let's say we're wondering what happened on Monday. We wake up, we go check our email. What do we see that tells us? Well, what we might do is just look at our account. Do we own 200 shares of stock or not? If the 200 shares aren't there, guess what happened? Contract got assigned, the shares were sold for $240. We have, in this case, our realized gain, plus we have all the income that's been collected. And we're just done. There's no further contract, then we don't own the shares. We now have just cash. On the other hand, if we see plus 200 right here, that means the shares were not assigned, they weren't purchased, we weren't called out. and we just kept our $1.65. In either case, there's nothing left for us to do. All right. Samantha says, what does it mean to buy out of the option? I said I wasn't going to do any more trades. But buying out of the contract, well, we sold to collect the $1.65 premium to get into the trade. If we ever want out of this deal, we buy to close the contract. That's it. And I know that's a little bit weird because we're used to buying something to start a position and then selling that something, buy a stock to start a position, and we sell it to close it. But when doing covered calls with the option contract, we sell to initiate the position and then buy back. But guys, we talk about in this webcast series the back-end management of trades. Now, I typically do that every Monday. Today, I'm not going to do it because I wanted to give more time at a higher beginner level to explore the idea of a covered call in a little bit more detail. So I didn't look at our existing portfolio, but every other week, if you go watch the archives, you'll see me managing trades and talking through the logic of getting out of the position. So you may want to check out those archives. So once again, that's a reminder. If you're new to this, make sure that you are subscribed to our Trader Talks channel on YouTube. Just pop down below the video, click on the subscribe button. Again, it doesn't cost anything. It literally only takes a second. You just click subscribe and it's done. But our Trader Talks channel on YouTube is where you can join the live stream. So you can come watch me again next Monday, and we will be talking about the management of this trade and the other trades next Monday. But you can also find the playlists of previous webcasts. So like I could go to the playlist here, I could scroll down, and a few rows up from the very bottom is my series right there, covered calls and short puts, and you can see the full playlist there. Now, another thing that Barb and I strongly suggest you do is to follow us on social media. You should be following your favorite Schwab presenters on social media. So you can follow, for example, Barb on X. You can find Barb and me on X. You can follow Barb there at Barb Armstrong CS. You can follow me there at Cameron May CS. All right. But I'm very active on X. And if you reply to one of my posts, I just try to reply right back to you. So for example, you'll notice in this discussion, I have this what's called a group, but I made an area on my monitor tab that's called example covered call so I could show you this position. How did I isolate that position? How did I create that group? Well, on my X feed, my latest post is here's how to quickly organize Thinkorswim portfolio positions into groups by sector, by strategy, etc. Just a minute and a half is about how long that video is. You can check that out. But some people reply to these. I just reply to those comments unless it's a little bit too far off topic or if it's like too hot to handle. I don't get into politics. Sorry. No religion. Nope, not doing it. But yeah, if it's on topic, we'll chat about it there. But you can also now follow us on LinkedIn. So you can find Barb on LinkedIn. Barb, I know you corrected me earlier, maybe, but you just go to linkedin.com/in. And then for me, it's /Cameron May CS. For Barb, I believe it's /Barb Armstrong CS, but that'll take you to my profile here, and you just give me a quick follow. And just like on X, if you reply to my posts on LinkedIn, I reply right back to you, and it allows for communication with your favorite Schwab presenters in between the live streams when the camera is not on. It's a very common question for me. How can I reach you? Social media is the answer. Can't have my email, sorry. But you can follow me on social media. All right, but guys, we've accomplished what I set out to do today. I wanted to talk through what a covered call is. I wanted to weigh the pros and the cons, because there are both. And then I wanted to do an example trade in our paper money platform. So we've done all of those. Let me just double check, make sure that I didn't miss anything. I always keep session notes, so I just want to make sure from my notes I didn't miss anything. Oh, there is one thing. Yeah. What types of stocks might we do covered calls on? Well, typically it's just the kinds of stocks that the investor or the trader prefers to own. They might be shares that are already in the portfolio. Now, not every stock offers options. And even those that offer options, if it's a thinly traded stock, the options might not be very liquid. They could be hard to get into or out of. But Beach Bums just says, can the holder exercise the option before the expiration date? Yes, they can. Yep. That can happen. Yeah, and really at any time. Yeah, even if in our case the stock is still below 240 and we think nothing's going to happen, they might just decide, you know what, today's the day I'm going to pay Cameron his $240 and be done with this deal. But guys, thanks for giving me your time today. Barb, thanks for helping out in the chats. Great attendance. I always appreciate that. There was a survey, so if you haven't filled out that survey, click on that link now. It's just 2 quick questions in a comments box and a suggestion box. And if you take the time to read through, or you take the time to fill out the survey, they send that information right to me and I read through the data. I read through the comments. It's never a wasted effort. All right. Thanks, everybody. Thanks for all the thumbs up. I can see over, 138 people have already clicked the like button. That's really appreciated. That's like applause to your presenter, but it serves another purpose, and that is it tells YouTube you liked this, and YouTube takes that as a signal to maybe show this webcast or this video to other people. It helps, it gives me a boost in the YouTube algorithm. So always, if you liked one of our webcasts, click that like button. It's very helpful. All right. Everybody go enjoy the rest of our webcast for the rest of the day. I will see you next Monday. I have other webcasts every day of the week, as long as the markets are open, as long as I'm not on vacation. I cover a range of topics in other series, so check those out as well. But I'll look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.